Hey everybody, Courtney Smith here, and I want to talk about rising rates wreck economies. We have been in a loose monetary regime for 18 months. That boosted the economy and the stock market. But the world has changed. We're now at the very beginning of a tight monetary regime, and the ramifications are huge. Right now, only a few countries have raised short-term interest rates, like Russia, but many countries, including the US and Europe, are talking about raising short-term interest rates by June of 2022. But the bond market is already dropping and rates are rising. US 10-year Treasury rates have gone from roughly 1.2% to almost 1.6%. That's a one-third rise. German rates have gone from minus 0.5% to minus 0.2%. What percentage gain is that? I don't know, because it's minus. UK rates have almost doubled from 0.5% to 1.0%. Only Japan has remained stable. The spike is largely coming off of the sharp increase in inflation that central bankers are blaming on transitory factors like supply chain disruptions. Of course, adding trillions of dollars and euros and pounds simply doesn't have any impact on inflation, according to our central bank masters. Unfortunately, the heads of all of these central banks are academics, so of course they don't know anything at all. They have learned how to keep themselves in power, not how to increase wealth and decrease poverty in society, which should be their job. Inflation will continue to increase, but at a slower rate going forward than so far this year, but still going up at going up to 6, 7, 8%. Yes, it's not a jump from 1 to 5, but we're still going to see it increase just at a slower rate. Inflation will continue to increase, but at a slower rate. The reason is that interest rates are moving higher, and the market is a gigantic homeostatic mechanism, and therefore higher interest rates will reduce the demand for loans, increase the cost to corporations, and that will slow economic growth. But inflation is not going to go down. So yields still have to rise to compensate for that. We still have very negative real yields, and that is simply not sustainable for very long. Yields have to rise to get back to positive real yields. The ramifications are huge. One big one is government budgets. Currently, the U.S. government is spending about $400 billion each year on interest payments. And that is with interest rates at the lowest they've ever been in U.S. history. We currently have about $30 trillion in federal debt. If interest rates go up by only 1%, then the federal interest payments would rise by $300 billion per year. That would be up to $700 billion a year. Are they going to cut this additional $300 billion out of other spending? Of course not. They'll borrow the extra $300 billion. And where is this going? Where is this borrowing to pay previous interest? Where's that end? The national debt is now increasing, it's compounding. Now, we've gotten to the point where with interest rates at zero, we're compounding our national debt. If interest rates go to zero, we're going to double our compounding rate. We've reached a point of no return. Tune in tomorrow, because tomorrow I'm going to talk about some more of the ramifications of this tightening policy, and I'm also going to start talking about what's the solution to the problem. Talk to you tomorrow.